The war in the Middle East is choking much more than just global oil supplies. The US Fed is frozen. Bitcoin is trapped in a range it can't escape yet. And traditional markets are cracking at the seams. We have a cascade of seemingly isolated but deeply interwoven events. And understanding how they connect is the difference between navigating this market and getting caught off guard. I'm Igor, Investment Director at Venionaire Capital, your entrepreneurial partner, and this is Crypto Insights. What do we have on our hands right now? Well, let's zoom out and assess the big picture first. We've got the war in the Middle East, and one of its major negative effects is the almost closure of the Strait of Hormuz. This narrow passage for oil and gas tankers and cargo ships is the choke point for the system-critical supply of raw materials that are powering the world economy. Less obvious downstream products include helium, which is relevant for chip makers and the AI industry, and fertilizers, which are relevant for the food industry, of course, besides the obvious oil and gas that are needed to run production facilities and logistic networks. So high energy and food costs feed into higher inflation risk, impacting the monetary policy of central banks, such as the US Fed. Last week's FOMC meeting unsurprisingly brought no change. J. Powell gave no further rate cuts given the market conditions and the ongoing third Gulf War. Hence, the market currently expects no further rate cuts for the entire 2026, as you can see on the tables. Other central banks of major economies have already started signaling hiking intentions, taking a more hawkish stance. So easing of monetary policy generally spurs investment activity and increases risk appetite. Higher rates do the opposite. This is relevant for crypto assets because they are risky investments. In times of turbulence and uncertainty, as we have it now, risk-on assets tend to be less popular than, for example, cash and government bonds or paying for your rent or food. The war on Iran is driving oil, gas, and food prices up. The longer the conflict lasts, the higher the risk of inflation going up. Government bond yields are already up, like US Treasuries, as we can see in this chart overview here. And it drives the odds of rate cuts further down. Such an environment is not favorable for risk-on assets. And this is precisely the environment that crypto is now navigating. But crypto entered it, I would say, already wounded. Crypto entered this environment already structurally weakened, coming right out of the October 2025 and early February 2026 market crashes. The crypto market had virtually no time to recover, and the next major crisis has already emerged. So before we look at crypto specifically, let's first check in on traditional markets, because what happens there is highly relevant and will inevitably spill over. The legacy or TradFi markets paint a worrisome picture currently, having entered a downward trajectory after their all-time highs from the end of January this year. The US equity indices, S&P 500 and Nasdaq, are already trading below their long-term moving averages, 200 on the daily, and significantly below their Ichimoku clouds, as we can see here for both Nasdaq and S&P 500 in the overview. The same goes for Nvidia, as the leading AI chip making and tech company and part of the Magnificent Seven index. So Google has lost its daily and 3-day trends. It looks exhausted and is on the brink, I would say, of breaking further down. So both Nvidia and Google are indicating that their top is in. The already mentioned shortage of helium as an irreplaceable component for chips manufacturing processes would spell doom for AI companies and data centers, potentially bursting the AI bubble that is already on shaky ground. This would hurt US economy and affect risk-off position. Additional fuel to the fire is the extraordinary level of market volatility, which is driven by current geopolitical uncertainty. Volatility remains elevated with cross-asset markets reacting hypersensitively to any of Trump's statements, especially in the context of the war on Iran, as we have seen yesterday, for example. His statements go from not doing any deals, we'll continue bombing, to willing to make a deal, let's talk, between the time market closes and opens again. What matters more are the actions on the ground, which often contradict Trump's statements, although Trump's statements contradict themselves anyway. Day traders love heightened market volatility, so this environment is not as, let's say, bad for all market participants. But intraday sharp moves up or down do not make a trend. Capital investment favors more, I would say, stable, predictable, and less volatile market conditions as we have right now. A few of Trump's statements will not stabilize the heavily disrupted spot oil, gas, and commodity markets and the supply chains as easily or as quickly. Now, with that broader context established, let's look at what this means specifically for crypto. Bitcoin and Ethereum are in a general downtrend and have remained range-bound for 2 months now, with several breakout attempts on a local level for each individual. Both assets are below their daily clouds and indicating the current downtrend regime persisting. So BTC price is capped at $71,000-$72,000 to the upside and some 62 to 64,000 to the downside. A positive change in risk sentiment would see BTC rally and test its next notable resistance band at 79 to 80,000 US dollars. Similarly, Ether already tested its upper resistance band around $2,400 and got rejected. So to avoid a retest of the early February lows during the crash around 1,800, Ether now must first hold 2,100 US dollars. Basically defend this level. Under current market conditions, there are, to me, no signs of any shift in the downtrend from bear to bull for Bitcoin, Ether, and broader crypto assets. The optimistic expectation is that Bitcoin and Ether hold their current lows and remain sideways in the current price channel without losing further ground until the overall market sentiment improves. For any long-term investors, this is an excellent opportunity for dollar cost averaging DCA into spot exposure, specifically Bitcoin as a primary and Ether as a secondary asset. As a rule of thumb, if Bitcoin is not doing well, then the broader altcoin market is even less likely to do well. Should we see persistent downtrends in US TradFi markets, it would highly likely drag down the already weakened crypto markets with it, although they have shown certain, I would say, resilience so far amid the turbulence that we are having, especially with Bitcoin. If it persists, it could help with the return of buyers' confidence. So the stress is also showing up clearly in the data, for example, in the ETF flows. Both global and US spot Bitcoin ETF flows have decreased week over week, which comes as no surprise given the uncertainty that we've had across markets over the past 3 weeks. So barely net positive ETF flows for the last week, combined with miners' capitulation, adds to the notion of prevailing risk-off conditions. And speaking of miners, higher energy costs are hitting them hard. Higher energy costs have a negative impact on Bitcoin miners and available hash rate, meaning Bitcoin's cost of production increases and Bitcoin network mining activities become unsustainable for some miners. Many of them have already pivoted to AI due to their inability to service their existing CAPEX and OPEX expenditures, capital operational expenditures, as well as any existing debt. After, of course, Bitcoin price spent the last 6 months in a downtrend and crashed or lost over 50% or roughly 51% of its value. So Miners' capitulation happens in Bitcoin downtrends, which can also be seen as a first positive sign that we are or might be in the process of bottoming out. Against this difficult backdrop, there are still some notable institutional developments worth watching. Saylor, for example, the famous alchemist of financial products, announced just yesterday 2 new vehicles at the market programs, or ATMs, for raising funds for corporate treasury purposes, including further BTC purchases, of course. ATM lets him raise funds in a flexible manner by selling preferred and common shares into the market over time as needed, rather in one big single move. So the BTC market reacted yesterday very positively, but given the overall conditions we have already discussed, the question remains whether, when, and to what extent Saylor will have success in A, raising the full $42 billion, and B, generating sustainable supportive effect on the BTC price in the mid and long term time frame, for example, sparking a meaningful rally for the BTC price. So my point is that if Saylor remains the sole dominant corporate treasury buyer, or one of very few big buyers, the BTC price might struggle despite nominally large buying. And we all know that Saylor is less sensitive to optimizing his average entry price. As soon as he raises funds, he just hits that market buy button. And as we've seen a number of times over the past 6 months, despite that buying, BTC price slid lower still. So while Saylor is doubling down on Bitcoin, other institutional heavyweights are looking, I would say, beyond Bitcoin. Another big player, BlackRock's Larry Fink, he finds tokenization more attractive than BTC alone and expects tokenization to transform traditional finance similarly to how the internet did it back in 1996. It will be interesting to see how Bitcoin and Ether spot holdings could get utilized in crossover between TradFi, DeFi, and the developing tokenization trend. At some point, adding AI and the agentic economy to the mix could usher in disruptive new financial products that were not previously possible, running on the blockchain as their backbone, but remaining invisible on the front end to the end user. But as always, regulation plays a big role and usually lags behind product creativity, delaying mass adoption. The bottom line is simple. Currently, cash is king, and premature or oversized positioning tends to get punished quickly. Thank you for watching.